Hi everybody, we are going to be looking at your fifth period work for the week beginning the 25th of Jan. Okay, just very quickly in terms of this, let me just pick up a laser pointer a moment and away we go. In terms of your booklets, guys, you should be looking at page 11 onwards in your macro booklets. And what we're going to be doing is we're going to be building on the work that we looked at last week, and we're going to be looking at the national income and standard of living. Now, in terms of this, we looked at measuring national income in your first lesson this week, and in terms of that, it can be measured using three different methods: expenditure, income and output. And obviously, if you're measuring national income, every single method should come up with the same level of national income or output. Okay, now in terms of this, just make a note. The examiner will expect you to know the different ways of calculating national income, okay, and it will be examined potentially. Okay, so that means in terms of this year, this can come up in your internal assessments. Okay, just a quick reminder, we looked at this last week. Expenditure method in terms of aggregate demand, and in terms of the equation that you guys need to know, and I hope you're thinking of it in your head, what does aggregate demand equal? And it's the total of all demand for goods and services within the UK, and it is C plus I plus G plus X minus M. So consumption plus investment plus government spending plus the balance between exports and imports, an absolutely vital equation for everyone to know. C plus I plus G plus X minus M. Okay, moving on to today's notes on halfway down page 11. Now, when measuring the standard of living, there's some key information in terms that you guys need to know. So we will build towards this idea, real gross national income per head or per capita adjusted for purchasing power parity. Okay, but this data hides, the data that you guys have got in front of you hides a lot of things. So in terms of the data that you guys have got, the question says, using the table above, explain why Norway is above America in terms of GDP per capita or per head rankings when the American economy accounts for 25% of world output. Okay, so what I'd like you guys to do, pause the video for 2 minutes, have a go at the question. When you've completed the question, sort of press play and see how you've done. Okay, so you guys have to have a go at this. Why is Norway above America in terms of GDP per head when the American economy accounts for approximately 25% of world output? Press pause now. Okay, I hope everyone has had a chance to have a go at that. In terms of the answer, though America has a larger GDP or a bigger economy, it also has a significantly larger population. Norway has a higher GDP per person, and so the value of GDP per person is greater than that in America. I wonder if anyone knows why Norway's GDP is so high. I'll give you a couple of seconds to think. And if anyone is thinking of North Sea oil or fishing, those are their two biggest exports. Okay, top of page 12. In terms of changes in real GDP, okay, so real GDP means accounting for inflation. And remember, GDP is gross domestic product, the value of goods and services produced per capita or per head. So we're looking for working out changes in the real value of goods and services produced per head when accounting for inflation. And you guys have got data here in terms of different years, 2004 to 2014, and you've got GDP per capita adjusted for inflation in the second row, going from $33,200 through to $39,511 per person. Okay, and you're asked what has happened to real GDP per capita between 2004 and 14. Now, the good economics here is being able to explain this. If I explain what poor economics would look like, it would be the people who are saying it goes up a bit, then it goes down, then it goes up. Okay, so we have to be able to explain this using good economic terms, good descriptive terms to describe data. Now, this is a skill that we will continue to develop as the course goes on. So again, press pause, have a go for no more than 2 minutes. Okay, and then see how you've done in terms of those descriptive terms. Okay, I hope you guys have had a good opportunity to look at that. So in terms of this, what I would write, GDP rose steadily, okay, from 2004 to 2007, rising to a peak of 35,600. You can see I've written pounds, that should say dollars. It then fell till 2009 to a low of $30,200, again that should say, and then rose continuously until 2014, rising slowly at first and then at a faster rate, and you can see the gap sort of increasing from 2011 onwards. What could explain this? Really, this is partly explained by the credit crunch, along with the rises in productivity, so increased use of machinery and training, along with any innovations to production processes or products. Okay, bottom half of the page, you guys have got this information, and the context reads, or the scenario reads, in country Y. So imagine a simple economy where there's only one product produced. We'll call it product X. Okay, in year 1 they produce 1,000 units of X and they sell them for £2. In year 2 they produce 1,000 units again of product X, and this time they sell it for £2.50. And the question asks you, using the figures, calculate the change in GDP in country Y and determine, country X that should say, and determine whether or not the country has experienced real GDP growth and show your workings. Okay, so complete the table. Again, press pause and come back in 2 minutes when you're ready, and also see if you can determine whether or not there has been an increase in real GDP growth. Okay, pause now. Okay, how did you do? 1,000 units of output multiplied by £2 gives you a value of GDP equal to £2,000. In year 2, with a higher price, that actually goes up to £2,500. Well, has there been a real increase in GDP growth? Not unless the quality has improved. Okay, unless the quality of those goods has improved and they can attract a higher price. If all that's happened is that there's been an increase in price, well, actually that would be a nominal increase and not a real increase in GDP. Okay, and that's why we have to take inflation into account. In this instance, it looks as if GDP has gone up by 25%, but actually all that happened was price went up by 25%, unless it can be explained via an improved product, okay, which certainly wasn't explained to you, so we would expect this to be a nominal increase. Okay, pushing on, just in terms of turning nominal GDP, so that's an increase in actual numbers without taking inflation into account. If we take an example here, let's say it was 14,000 billion in 2013. Okay, in terms of a price index, if that's our starting year, that would be 100. In 2014, if the nominal value of GDP goes up from 1,400 billion to 1,450 billion, and the price index increases to 103, what has actually happened? Okay, and we can work this out. Okay, and this is the equation you use. So the nominal GDP, okay, multiplied by 100 divided by the price index in 2013. So 1450 multiplied by 100 divided by 103, and we can see that actually real GDP has gone up by 8 billion, not by 50 billion. Okay, so we now adjusted for inflation, and so we can accurately say what has happened to the economy, and we've taken into account prices, and that's what a good economist will look to do. Okay, if you guys can have a look at page 13, adjusting GDP for differences in living costs. Okay, now in terms of this, real GDP takes into account inflation, but actually what we also need to take into account is the difference in cost of living between different countries. So if you want to take an example of that, if you guys had £10 and could take that into a McDonald's in the UK, that would buy you presumably significantly more than it would in a McDonald's, let's say, in Zimbabwe. In Zimbabwe it would buy significantly more than it would in the UK. So we need to take into account the purchasing power of money, okay? And we can adjust this using exchange rates, okay? And we call that purchasing power parity, an important point. Sorry, that was on the bottom of page 12. Okay, top of page 13. In terms of standards of living and alternative indicators, let's run through this very quickly. In terms of things, rather than taking GDP or GNI, real GNI per person adjusted for PPP, this cost of living differences between different countries, we can take alternative indicators into account. So how many, what percentage of the population own different consumer durables such as TVs, levels of home ownership, the amount of patients that there are in a population per doctor, hospital waiting lists for important operations. All of these could be seen as an important indicator of the population standard of living. We could look at the number of children per thousand of the population who die each year. Okay, average food intake. We could look at literacy rates or crime rates or estimates of pollution to try and work out more accurately a standard of living, or to certainly help provide a fuller picture. In terms of limitations of GDP when measuring living standards, just try and consider this. We might get GDP figures for Wales, but in Cardiff it's going to be significantly higher than in West Wales or in the valleys. Okay, similarly in England, between London, the southeast, and then maybe the north of England. In terms of economic growth and externalities, you've only got to consider what's happened to China. You can have significant growth, but actually it doesn't tell us anything about the level of externalities. In terms of leisure and working hours, if we have got a higher GDP per head than, let's say, France, but we work an extra 10 hours a week on average, okay, that isn't giving us the full picture on the GDP figure alone doesn't give us a full picture of living standards. So we need to take into account leisure and working standards. We need to take into account the balance between consumption and investment. If we are consuming too heavily now, and growth looks really high, people might think the economy is doing very well, but if that's using up resources for future generations, that should also be taken into account. The shadow or the black economy doesn't take into account people who do jobs, let's say, cash in hand, or who work outside the legal limits in terms of employment, in terms of contracts and working conditions and so on. So these things should be taken into account. Okay, there are a couple of other things that you guys can consider and that other economists are trying to take into account, and a couple of those have been looked at. Okay, what I want you guys to do is have a go at this past paper question. You need a ruler and you've got to calculate Japan's percentage increase in GDP for the 20-year period 1990 to 2010. Okay, so work that out. What was it in 1990? What was it in 2010? Pause the video for 2 minutes and have a go. Okay, hopefully you guys have had a chance to do that. This was my workings out. Okay, 5.3 minus 3.1 over the original 3.1 times 100 gave me 71%. Not completely accurate. I think you can't see everything there. The WJEC accepted calculations within the 70 to 80% range. Okay, that is it for me. You need to go on to your short answer question.